Hi, Noah. So last year, we expanded the Income Plus strategy to investors in Europe and Asia by launching our Global Income UCITS Fund. Fast forward to today, we are now celebrating the fund's one-year anniversary. Can you give us some insight into how the team's 6-month investment horizon has influenced the fund's positioning over the last year?
Absolutely. So 2025 has been a year that's been characterized by all sorts of volatility in interest rates, credit spreads, even policy shifts that we've seen. I think highlighting the period in early April when we had the announcements around the Liberation Day tariffs shows this 6-month outlook in action, where we allocated the portfolio by reducing our positions in investment grade corporates and into a barbell position of mortgage-backed securities and high yield bonds.
Central banks worldwide seem to be shifting into easing cycles. How do you stay unbiased and nimble when allocating globally?
Yeah, so this situation is really one where you want to be very selective. Choose your yields, but don't chase, don't reach for yields at this point in the cycle. And the way that we're thinking about that is investing more in short to intermediate corporates. We're seeing some value in some of the securitized subsectors that are higher quality as well. And then there are some opportunities in global government bonds outside of the US, including in emerging markets.
So, given that fixed income credit spreads are really razor thin currently across many asset classes, where are you finding value today?
Yeah, I think that is the challenge, right? You have to be disciplined because valuations are tight. But you can't be complacent because fundamentals are still very, very strong. So, what we're seeing is we think in terms of positioning portfolios to be underweight, 30-year part of the curve. We do want to be higher quality because those credit spreads are so tight. Having said that, there are some opportunities in high yield bonds, including in short duration double B types of securities as well. And security selection is also critically important at this point in the cycle.
Got it. So, certainly opportunities if you know where to look.
Yes.
Lastly, why should our viewers consider a flexible, global, multi sector approach to fixed income investing today?
I think it comes down to really two things. One is there's an acknowledgement that yields are high, and this is true nearly everywhere globally on a relative basis compared to where yields have been. Having said that, risks are not evenly dispersed. And so I think what the flexible bond strategy allows you to do is to be able to search for and invest in those attractive income yielding securities, but to be able to do so in a way that allows you to manage those downside risks.
Sounds great. Well, thanks, Noah, for your time and insight today. Appreciate it.
Thanks for having me.